episode and let's crack on. So, welcome, guys, to our third episode of the Wealthcast podcast. Thank you for being on. If you're on YouTube, if you're watching us live, however you're watching us, great to have you on. Okay. Now, we're still in the early stages. There's a whole lot of content to teach and a whole lot of things to discuss. But for me, having the heart of a teacher, the best thing to ever do to build a good building is to have the right foundation. And after you have the right foundation, you need the right levels to build on top of each other till you get to the top. Okay, which is what we want to do. All right, so I'm going to crack on and do a recap for about 10 minutes as to what we are discussing. So last week was an interesting week. Okay, we started to talk about currency devaluation versus currency and the whole idea of currency depreciation in or the depreciation and then the devaluation and all of those different terminologies. So I think I'm going to go back over there now. At the moment in 2021, as we've got into the roaring 20s, we're in a stage of time which is, I would say, now every time is crucial throughout history. Every moment you have, theory, not in theory but facts, every moment you have, every time you take a breath is a time of opportunity. Okay, but then there are times and seasons where opportunities are more apparent. Okay, now for example, there was a really good time to buy Bitcoin, which was during 2009 all the way up to, I mean, there was always a good time to buy Bitcoin, but in terms of price, definitely it was good to buy Bitcoin around 2009 to 2011 when they were like 6 cents a coin or 6p a coin in UK money or something like that, rather than buying it at 40,000. Not that you shouldn't buy it, but I'm just saying, there's always time, okay, and opportunity. And so it's necessary when it comes to understanding what we have as an infrastructure for price, we need to, and for future, we need to, go back in the past. So now today's lesson, okay, I'm gonna put the lesson out here as to what we're discussing. Okay, this is the beginning. I'm talking about the new era of banking. Okay, and I'm gonna go into very deep detail about a whole load of things. I have some financial sheets to look at. We're gonna look at things from the Bank of England and different things for you to understand what you're in right now and what we're trying to shift to. Okay, so the new era of banking. All right. Now, before I do that, let's have a recap, as I said, and then we can go from there. Now, these things are just as important as trading. Okay, trading is just the outflow of these intrinsic things that happen day by day within different systems that either collude with each other or related to each other, or they collude with each other directly or indirectly, whichever way. All right, so we're having a recap. So let's talk about, as I said, we're still on the gold standard system. And for those of you who may not remember, let's quickly just go through that again. I'm going to draw up the gold standard system picture. So we have gold, okay, which is our picture of what we have. And I'm going to put them into different eras. All right, so take these period separators as separation between different eras of time. Okay, so we have a gold standard system, which was or a type of system that involved gold, at least, or a type of system here. All right, so I'm going to put this here: world reserve currency. All right, and then underneath that, I'm going to put the currencies of the world. All right, let's put this here. Now, our industry is changing when it comes even to us as trading forex. It's important for us to really understand and delve deeply into understanding what the changes are, around us, what's taking place. Okay, there's so many exciting things to share, and I said I always have that feeling where I feel like I'm about to just explode and say so many things, which if I do at the wrong time, it won't be beneficial. Okay. So we have three levels to this system, and this system I'm describing here is simply the Bretton Woods system. So we know the history. For those of you who have been coming to the sessions, okay, you know what we're talking about. In order for us to understand that, we do need to understand that bits of, well, I mean, not a bit, but we do need to understand history in a wholesome way. So if I go from here, we have the 1944 Bretton Woods system. Bretton Woods system. So with the Bretton Woods system, as we're, going for, this system was based on the fact that there was a crisis, okay? And the crisis that we had was we were in a point where the price of things. We had deep devaluation, okay, in things, okay, but we had quite a mixture of different types of fiscal things going on, and along with central bank policies, like for example, devaluation of currencies, okay, the devaluation of purposeful devaluation of gold, okay, but then also we had deflation, okay, and we had deflationary tools put in place to be able to manage the crisis. But we had, I'm going to put it here. So this is the time period after World War One, after World War Two. Okay. So after World War Two, and of course after World War One as well. But the direct effects, stem mainly from the World War. Now, as you know, whenever crisis comes, it brings destabilization. Especially destabilization happens whenever war happens. Okay. But then when you have a system like this, okay, and the systems we have for today, it's more scary today if a war was to break out in the world than it was back even 50 years ago. Not only because of technological advancement, but because the fallout from the war, is going to be exponentially greater than it was, in 1944, so 70 or getting towards 80 years ago. Okay. So with this Bretton Woods system, what is the system? All right. We have gold as our standard or our monetary value. So gold is the actual money. Okay. So gold is the money. Now, when I say money versus currency, I always try to make a differentiation so that it's better for you to understand, what we're going to talk about in the future and stuff. And for you to understand when your salary comes in, or when money, as we call money, which is actually just currency, enters your hand, what does that mean? What does it represent? When I have £500 in my account, I know it's £500 and I could buy, I don't know, whatever, but what does that mean? Or what can I do with it? How do I expand on it? What do I do? So money, okay, store of value, okay. So money, okay, is a store of value, or SOV, okay, because the intrinsic properties of money is that it must be a store of value. It must have some sort of value to the economy or the system, okay, and therefore money, all right, has to have certain probability. I'll keep this there again. Said it again. Probabilities because of what I want to say next, but certain properties as to why that money is money. So we know with gold, just to put the recap here, that there's quite a few properties that it has. First one is that its chemical properties. Okay, its chemical properties are second to none. Actually, no. I say that there are some contenders in a way, but gold is, let's just keep it that way. Gold, in terms of its chemical properties, are the best. So chemical properties that we have is very inert. So the inertness that gold has, as I've discussed many times, and I won't go into too much rambling on about it, but if we put the properties of gold, gold is chemically inert. So I'm doing this because it's important for you when you speak to other people and you discuss what you're doing, that you're involved in trading or you're involved in the financial world. Many of the sometimes looking from the outside in, it actually doesn't make any sense sometimes. I mean, apart from, yeah, you're gonna buy a stock and sell it and stuff, but is a lot more deeper to it, because the money of the money currency is the foundational infrastructure of the world that we live in. Okay, every country, the first thing you have when you establish a country is an economy, a means of exchange. Otherwise, the country can't be a country. So it's very crazy to me when people come up to me and says, "Oh, I don't trust crypto, is a risk, or forex is a risk. Everything is a risk." And I guess sometimes purposeful teaching. The rich don't get taught that money is a risk and currency is a risk in the same way that we do. We get taught in the sense that it has a negative inflection on our mind, which is we should not get involved in anything that's not the bank, or not the local, the normal savings account, okay, because that's safe. The structure has been put in place, governmental, and figures and different things have put in place for many, many hundreds of years now, that we should trust the government, and you know that's it. What they say goes, and what they say is right. And sadly, the truth is that many governments, if not all governments of the world, usually don't have the people's best interest at heart. you know I haven't found any country just yet who generally has the people's interests at heart. Maybe there's a few, but I don't know of them at the moment. Okay, so let me just put this at the top. So gold's intrinsic properties, we have its inertness. Okay, we have its fungibility. Okay, And fungibility means the ability for it to be turned or to be tokenized or to be used as a means of exchange. Okay, for example, if lava was precious because it's rare, because lava is rare, lava isn't fungible because if you carry lava, you can't exchange that because you're gonna kill yourself and the people around you. You wouldn't even get a chance to because you'd be melted before the lava. So I know it's a wild example, but that's what we mean. So fungibility, it's inert, it's fungible. I mean, gold isn't poisonous, you know, in that regards. If you took a piece of gold and stored it, it wouldn't kill you, you know, stuff like that. So this is one of the properties. And then also we have divisibility. Now, the divisibility of it, okay, is because it can be in a sense denominated in the sense that you, for example, you can have 1 gram of gold, you can buy 10 grams of gold, you can have, 2.583, 2.352, etc. grams, okay, of gold. This is one of the things that make gold gold. So it's divisibility. Okay, for money to be money, it needs to be divisible so that it can be transported and etc. around. All right. So these are some of the properties. I'll explain the others in a moment. Put this here. I'll take away this because it's not chemical properties, it's just properties. So we'll just write this out here. All right. Now, when we're looking at the price of things, we always need to understand, what does the price mean? And I think one of the things that I really want to make sure I achieve with this wealth podcast and teaching, for my students too and for everyone listening to us, is to make sure that you have a deep understanding, at least, or a good understanding of the world around you. Okay, what is going on? And these teachings are important because one day, when the time comes, you're gonna need to know, what to do. All right, and if you don't know what to do, especially in these next 9 years, for example, you could find yourself in a very, very uncomfortable place that you wouldn't expect it. What's sad is that change or the changes that are going to happen in this world are going to land on everyone, but most people will not see it coming at all. And because they don't see it coming, they have no plan. Okay. This is like strategy lessons in the war room before we actually go to war. Okay. So coming back to this, after World War II, 1944, we have a store of value, which is gold. Now, the currency, okay, what would be the currency? In this case, the world reserve currency is the dollar, which means that the gold gold is backing the dollar, and then the dollar itself is backing other world currency or is pegged to other currencies at different values depending on the different factors going on. So the currency, all right, in this case would be, all right, the representation of value. Okay, the representation of value is the currency. So the dollar wasn't designed, okay, wasn't designed to be the money. It was designed to be the representation of the money. Okay. And so when you have a paper note in your hand, when you look at the, for example, for us in the UK, when you have a £20 note, £10 note, £1 coin, even a 1p coin, okay, that coinage, that pound, that note, okay, has been minted, okay, and been authorized by the necessary parties to say that this piece represents a percentage of what should be money, okay, and you can exchange these pieces of currency, okay, and if you wanted to turn it into the actual representation, you can go to the place to do so. For example, usually it would have been, for example, the pound sterling, as we learned last week, is based on £1 of sterling. Okay, that was what the system was for. So a lot of the times we don't use the term sterling, we just say pound, but that's how far away from we've got from currency. But even though we've got so far away from currency, sorry, from money, all right, by not even knowing that is what the pound sterling is about, doesn't mean that you shouldn't, you know, put the time in to get to know these things because it's deeply important. And when you do so, these things, you know, are the are the most important things to reconcile. But anyway, let's continue. So we have the world reserve currency, that's a representation of value, and then all of the basket of currencies around the world are backed by it. This is the system. This system failed in 1971 because we know what happened. So I put this here. So now the system we had, it was ended in 1971, and introducing a new system, we have a petrodollar system. Okay. So even though I know I say we have a fiat system, which is what it is, we have a fiat system taking place at the moment. What really the dollar is right now, okay, or what is backed by, apart from fiat or government promises, really and truly what we have right now is a petrodollar system. okay, which means I'm going to put this here, okay, in a sense, okay, oil is backing gold, sorry, backing the dollar to some degrees. Okay. Now, the reason why it's like we have this petrodollar system, okay, from 1971 onwards, they made this plan in 1974, or the deal that they made with countries from around the world is that I'm going to put this here is there's a simple deal is that if you want to buy oil, okay, you need dollars to do so. Now, by doing this, it creates, some of the most simple but crucial foundations to an economy, which is this supply and demand. Okay. Because now there's going to always be a continual supply and demand for dollars. Okay. Many countries around the world are going to need to have dollar denominations in order for them to buy, and, which is a very clever idea that they came up with in order to buy oil, which is necessary for countries, to have going along. So, where are we right now? We're in a system right now where we have what we call fiat currency, as you know. All right. And this fiat currency system is from the word fiat, based on government promises. Okay. And I know this sounds like a repetition for those of you who have been with me, but I'm running through this very, very quickly. Okay. Government promises. Now, this fiat currency, okay, has a system. All right. So if I start with what we're going through today, I'm going to discuss two different systems that we have in place at the moment. Okay. And they actually are competing with each other. All right. So, and put this here. If I put this right here, now in order for this to be managed, we have a system for currency. Okay. System for currency. All right. And the system for currency we have in an economy, all right, should be ringing a bell, should be banking. Okay. So the banking system, okay, is designed to manage value, okay, or what we have as a banking system. Now, the system we have for banking, and this is an important term, is that we have a banking system, okay, and it's based, let me put this here, based on centralized bodies or centralized parties managing the system, okay. So this is an important new term that I'm bringing in, which is the term centralization, okay. Centralized or being centralized is in the banking system, in any system, is where, okay, the majority of a system. Now, I've said this term very often, managing, let me put this here, system of currency. All right, I'll put this here. So when it comes to a banking system, for us to understand the new era of banking, we need to understand the one that's in place at the moment and is currently being destabilized at a very fast rate. So this old system, or this passing system, okay, which will soon be obsolete, okay, and most don't know, is the system we have now. And this system is a centralized system, okay? So the centralized system that we have has different moving parts to it, as of course it would go to have, okay? So in this system is very simple. We have levels of banks. So we have a central bank, okay, which is level one. Now, for those of you on the course, this should be lesson 1B, which is market hierarchy. So in that lesson, I didn't, even though we talk from a different, totally different angle when we're discussing to do with trading, but the same principles applies, okay? But just we're talking from a different angle here. And then we have large banks, all right, which is level 2. And then level 3 is that we have high street banks, okay? So we have levels of institutions, okay, which um, these institutions, okay, as a conglomerate, okay, in terms of the ratio of how many of these exist and how many people live on the earth, you can call the system centralized, okay? And I'll go into further detail. So we have central banks, large banks, and then we have, I'll say the next level down, which will be high street banks, okay? High street banks. Okay, and these can be both national high street banks or international. Okay, I'll put banks and building societies because building societies they act the same way. Building societies. All right. And I explain the difference of building societies versus banks in a moment. I promise. All right. So with each of these levels, okay, in a system like this, all right, this kind of system is what allows, and of course, money from here or currency as we know it will flow into different industries, into different things for both buying and selling. So these this structure here, okay, is the backbone of how currency works. Now governments do play a role in this, and I'll come to them in a moment, but this is the system we have when it comes to a centralized system at the moment. This centralized system, okay, let me put this here, has some things and some features. So if you're taking notes, I'm going to write this here for you so that you guys can have a look, and I'm going to draw these along as we go along. So the diagram of my mind, whenever I'm thinking about this, okay, I think of this as, okay, kind of like a ladder in some senses. All right, but in between these levels, okay, we have a few things. So the first thing that we have between the central bank level and the large bank levels, okay, would be monetary policy. Okay, monetary policy, and I'll go into deeper detail because today I am, as I promised, when Liz asked a very important question and she discussed about, or she said about the fractional reserve banking. I said that in week 3 I would, which is today. And I will discuss fractional reserve banking because it's crucial to understand for your own selves. If there is fractional reserve banking, is there a replacement? What can we do about it? What is it? And etc. Okay. So between these levels, we have monetary policy. Okay. And the monetary policy covers a vast range of things, but central banks as an infrastructure, they're responsible for things like, and as I said last time, we have areas such as interest rates, okay, quantitative easing, and or I'll just say money circulation, okay. I'll put this here. Fractional reserve banking, okay, and other things, but I don't think there's enough space, so I'm going to continue. Now I'm going to split this up into chunks that can be digested, so I'm not going to load all of the information into one lesson, okay. I'm going to, you know, do it in a way that is, helpful and beneficial for everyone. So when it comes to monetary policy, the central bank or central banks, okay, there's about, now there's, for each country in the world, there's about 206 or 200 and between 200, is it 206? Between the, I think I'm not too sure. Somebody tell me if you don't know, how many countries are there in the world? How many countries are there in the world? I think it was 206, or maybe I've got the number wrong. Okay, 195. Okay, but maybe there is probably another 11 that are unrecognized, but they are countries. However, roughly, when it comes to central banks, there are over 100 central banks for sure. I believe there's about 154 at the moment from my last count, something like that. Okay, so when you consider, all right, this ratio, and I want you to keep this in your mind, all right, there are 7.2 billion people in the world. Okay, now not all of these people are what we call banked. Okay, so 7.2 billion people in the world. And this is another reason why I want to talk about today and the exciting opportunities that are available. All right. Now, if there's 7.2 billion people in the world, how many people are banked roughly from last check? I, my calculation that I had was about 2.6 billion, something like that. People are banked. But in certain countries, of course, it will be 100%, depending on where you are in the world. But uh, let's put this here. So roughly around about, I think it's 2/3 of the world that are banked. So and the other 1/3 isn't. So two-thirds of the world has a banking infrastructure of some sort. So that means account or something like that. All right. And then 1/3 doesn't. So we're talking about, let's say 4.8 billion, 4.8 approximately to 5 billion people. Okay. And there's still 2 billion people in the world that don't have a bank. And this is for certain reasons. Because one of the biggest things about centralization, and yes, centralization, okay, has worked for quite a number of years by force, but now with new technological development, which is usually the icebreaker to destroy or to do away with one system and start up another one, is cryptocurrency and what we're going to discuss a bit, decentralized finance. Okay, so decentralized finance and cryptocurrency, one of the things that we'll discuss is, you know, this move away from centralized finance into decentralized finance. And I've been wanting to share this for many, many weeks, but I haven't actually put this into place. So I'm going to keep this here, 220 billion. Okay. I just put 2.20. You guys know it's in the billions. All right. So this is kind of the ratio that we have. Now, with these centralized banks and institutions, if you think about it, if we talk about the 154 and we have the bank people, so for those of you who are my students, you know this term. I've talked about it so many times, and I'll keep banging on about it forever. And it's called the sheep to shepherd ratio. The sheep to shepherd ratio is something that I developed, when I was probably like 22, developed as a concept that I will teach one day, but it was from my own thoughts. And the foundation of this concept is very simple, which is, you know, in any economy or in any sector or industry, all right, by calculations that I did, all right, approximately, and I'm going to put the line here to show it, approximately 2% of that industry or 2% of the people in there, in that industry or sector, control the entirety of that sector. Okay. And I'm throwing all of these different pieces of the puzzle so that you can get a picture to what I'm talking about. Control that sector or industry. So when we're looking at the price of stuff, as I said, coming back to it again, we need to understand all of these things. What is value? What does value mean in regards to all of these different things that we have here and these different pieces of information? So with centralized finance, okay, we have this number right now who are part of this banking infrastructure. At the top level, we have the guys who make the decisions on what currency means and what value it has. Okay, and that's a dangerous position to be in, as in for it's dangerous if you're at the mercy of this position, but it's amazing if you're the person on the other side and you can control this decision. Okay, because you can, with colluding with the government, which is what happens usually. And as I said, we talked about this in lesson one, when fiscal policy, which is government regulation, and central bank policy collide together, usually we're in some sort of financial crisis and they're trying to bring some sort of recovery. So I'm going to put this here, government. Yeah. So government policy. All right. Are you guys all with me so far? If there's anything you would like me to mention or anything, just let me know. Just put a yes if you're with me so far. If there's any questions, please let me know. Okay, this is an open forum. I'm teaching, but we're just discussing. Okay, so we can prepare ourselves for the future. So if there's any questions, please just type in the chat instead of unmuting the mic for the sake of the recording, and just type it out, and I'll definitely go through the question. All right, but continuing on. So at this level we have here with central banks and government policy, okay, these two collude on this level. And so we have a monopoly here. Whenever there's centralization, always remember this creates a monopoly. All right, and I'm going to write this down here. Centralization of anything, because of the nature of how humans are, centralization, always remember this, equals to monopoly. I'm going to put this here, market or monopoly of uh, industry. I'll put it here, monopoly of rules, regulations, and value system. So the system of value, the rules and regulations that go along with all of those things, the rules of engagement, if you would like to call it that, whenever there's centralization, okay, and there's central bodies or a small rate, there's a large ratio of people who are in an industry and then there's small amount who control it, we always have this kind of dynamic, no matter what it is. Okay, this is just how things are. Okay. And so leaning onto the new banking era, okay, what is the new banking era? Now, right now, for those of you, everybody by now knows about cryptocurrency and about the changes that are taking place. I think most of the people that know about cryptocurrency know about it from the angle of, I would say, the financial gains, especially that people are receiving from being a part of this industry. You know, whenever you speak about crypto at the moment, which is sad, but this is why we're here, most of what people know about cryptocurrency, for me anyway, who I've spoken to, they either know about Bitcoin, which is I think is a given now. I think everybody knows what Bitcoin is. Just at least I know what I've heard of it. If they're a little bit better, then they know about Ethereum to a light degree. And then if they're a little bit deeper, then maybe they know about Dogecoin. Okay. So there are some cryptocurrencies that have a lot of social media presence to them and are quite famous because they've been made famous by different, people. But aside from that, that's what people know most of, nothing else really. Okay. And so, we're in a place right now where and I keep saying this. So these roaring 20s that I'm discussing, the reason why I'm saying this is because as a, being born in this time, us being alive at this time, we're at the crucible where there is a shift from one, from an old era into a new one. Now, that doesn't always happen in every time period. Okay, if you think about when we get into the 1920s, so in this centralized system, when we talk about this system of central banks and different things like that, okay, the Federal Reserve was, after some crisis, excuse me, some crises that happened in 1907, especially, okay, into, coming into the 1930s, we have this period of time where in 1913, so 1913, I'm going to put this here, we had the Federal Reserve created. And the Federal Reserve is actually called the Federal Reserve System because that's what it is. It's actually a system. Okay. Now, as I said, there's deeper theories as to, what this, because the Bank of England is for England, the Bank of Scotland for Scotland, and etc. But then after we have the Federal Reserve System, the Bank of America is just a large bank, but it's actually not a central bank. Okay. Rather, we have the Federal Reserve System. So there's theories that, it's, there's a lot of theories, but we're not going down the conspiracy theory road because I like them too much and I think I'll stay there for too long. All right. So coming back to this, in this situation that we are, I think I've spelled shepherd completely wrong. Okay. All right. Shepherd ratio. So the sheep to shepherd ratio is a very simple concept, and I'll expound on it in weeks to come. All of my meditations for the years of me being in trading and finance and stuff like that, all my thoughts. Sometimes it makes me laugh when I used to do my examinations at the back when I used to work at a building society, years ago now, when they used to put me on exams for the whole day and I'll just be taking in all of the centralized information. And I used to sometimes wonder, what am I even learning this for? This is absolutely useless. But I just had a kind of an epiphany that, this is why I'm here, because I have that background in order for me to be able to lead as many people into the new way of finance. Now, the good thing is that the year of decentralized finance was just 2020. That's when things really started to have um, some kerosene put to the fire, if you want to say it like that. We're only 1 year in, so we're very, very, very early into the foundation. Now, the concept of decentralized finance starts with Bitcoin, and then it's become more developed from 2017, and then into 2020 is where we actually saw the rise of decentralized finance to create a status that we are in 2021. So you're only 1 year and 1 month into this new industry. It's very, very young. But why I'm saying this now is because if you do this right now, I always used to say and wonder with my parents that, when they were my age or younger, why didn't they think to buy Apple stock when it was like £1 a stock? Or why didn't they buy gold and silver when, silver was like, I think £5 for a coin or £4 a coin or something like that? When things were very cheap, why did they not have that information? And if they had done just a few changes, you know, life would have been even sweeter. from an earlier age or something. Those are the things I think about. So, I can't hold them for it. That's what they've done. But one thing I want to do is that I made it my mission that wherever I can help and support and share from the bottom of my heart, I will do so to make sure that everybody has the chance to know about these things. So, a lot of people right now, in terms of cryptocurrency, feel like because Bitcoin is already at 42,000, they've kind of missed the boat. But I can tell you this, that there's a lot more going on than Bitcoin. And, and if you stay hung up on that, even if you missed Ethereum or something, or even Dogecoin, there's still even, m- deeper levels of things that need to come to the surface that will do. And if you capture it right and come to these lessons, you definitely will find out. Okay. So moving forward, with what we have. So we have centralization. So we have a monopoly of rules, regulations, and value system. Now, central banks and governments love monopoly. Okay, they love control. Okay, what better way to control the people than by their money? Okay, and by their currency. If you take away or you have the rules of the system to a game of currency or the game of currency in an economy, all right, then you've basically won. Okay, because nobody can do anything without any currency in their possession, or they can only do things according to how you say. And so you can create the rules in your favor. Okay, and this is where we get the concept that the banking sector is made for the rich and etc. And I understand that. But you know what? I used to complain all the time whilst they still got richer and it didn't do anything for me. So I made my decision that I need to learn and know what they do and see what can be done better. As I always say, my one of my favorite books is that from Shantru, which says that, if you want to beat your enemy, you have to know your enemy or become like them. And it's the same in the market. When we look at algorithmic structures, we're only looking at what the enemy's playbook, and we're just planning ourselves around that. Okay, in short, that's what the entire Wolf Group Academy course is about: knowing your enemy and planning how to, beat him or her or the robot. Okay, so this is what centralization occurs, and in this level we have this. So then we have large banks. Okay, and these large banks have their own policies, and these are not monetary policies, they're based off of monetary policy. But on this second level, as we go down, all right, we have this thing here, and what we have here is the next term, which is liquidity, okay, and credit. All right. So when I was, theorizing this and saying how would I deliver this, when we get to this level here, in every single level we have some intermediate processes. So when we get to large central banks to large banks, now we're talking about liquidity and credit. Okay, large banks have a lot of liquidity, credit. Okay, and I put this here in the form of like, assets. All right, things like that. I'm gonna put here. Now I'm putting the assets as a broad category because assets can be things like debt. For the banks, debt is an asset. You can actually trade debt. It's called the market of swaps. Now, funny enough, retail traders don't have access to that. In order for you to have access to that industry, you need to have some sort of institutional body governing behind you and probably doing exams. Interesting enough, but it's called the market of swaps if you didn't know. Okay, so the market of swaps, you can trade debt as an asset. You can trade it just the same way you trade other things, which is absolutely crazy, but this is the depth of how bad the system is. Okay, and then we have high street banks. Now, when we get to this level of high street banks, in between all of these levels, we have a next level here. Okay, and this next level, or this next part of the banking system, is this. All right, and it's called intermediaries. All right, because we have centralization. Okay, there's always going to have to be a middleman or a party. All right, intermediaries. Hope I spelled this right. Forgive me if I spell it wrong. All right, so intermediaries, I'm going to put this here. Okay, the middleman or the middleman, to make it something colloquial that you remember. So the middleman, and these middlemen, their responsibility is to provide different aspects of an experience of what an economy should be. Okay, so they provide things like, okay, payment solutions, payment systems, okay, payment gateways. okay, gateways, okay, things of that nature. And I put this here. And then it falls down to us. Okay, so there's so many different levels, but one thing that's concurrent with these industries, or this industries around this central system of an economy and money and banking and stuff like that, is that we're always the final people, or we're at the bottom of the chain, and then there's us. Okay, so when we have these systems here, central banks, governments create their policies of how much money is in a system, reserve, fractional reserve banking, which I'll talk about in a moment. Okay, liquidity, high street banks, you know, liquidity, assets, credit, things like that for loans and whatnot. Then we get to this place, intermediaries, which is the connectivity between us and this system. Okay. And when we look at this system, okay, the system is decided to be one sided for you to be on the lower hand, even though they try to make it seem, and they spend millions on marketing to make it seem like you should, they're for your benefit and they want you to have the upper hand. When the truth is, it isn't for your benefit whatsoever. Okay. And I explain why. All right. So, first of all, intermediaries. Now, every time you make a payment, okay, so payment gateways, if you talk about international payment, okay, or payments, for example, for me, working around, the banking sector, or I say retail banking sector, we have stuff like Swift payments for us in the UK. All right. Internationally, we have stuff like SEPA payments, which is European payments. Okay. We have these kind of payment gateways, okay, which do cost money. All right. And now, what are the problems with these systems? Okay. For example, now faster payment is probably the best we have. All right. But just for, I'll put online banking as well. Okay. Faster payments for those of us in the UK, and probably in other places too, etc. Payment gateways, for us to be able to interact with this system of banking. All right, I'll put this down here. All right, or just leave it here. So all of these different systems, you need intermediaries for it. So the high street, of course, is our place where that we keep currency in. Okay, but then there's intermediaries in between all of the transactions, when we put money in, when it's paid in, when it's taken out, when it's transferred to someone else, when we make payments for things. There's these different intermediaries, and what they do is that the problem we have right now is just simply two things. Okay, high fees. Okay, and I'm going to put here, the second one is lack of privacy. Okay, and this is an important point as well, lack of privacy. All right, okay, slow transaction times. Okay, relatively slow transaction times. Okay, so with the relatively slow transaction times, okay, this is relative to what we're going to discuss in a moment, but these are the major things. Now, one of the biggest issues that we have right now, okay, is not only just this. Now, there are high fees. Now, even if you go to pay through, I don't know, Western Union, okay, the money doesn't arrive straight away. It takes a couple of hours. Okay. Now, I'll break down next week, okay, the different infrastructure inside of between just, you sending a payment, let's say internationally from the UK to the US, how many different intermediaries there are. Okay. And so what we have is a cumulative amount of intermediaries when it comes to, for example, international payments. So I'll write it here. All right. International payments, especially, are probably the ones that have the highest fees. Okay. And if you've always wondered, why is it so difficult? If you know where the person is and stuff like that, why are they charging me so much money? Okay. I'm going to put this here, cumulative intermediaries. Okay. So these cumulative intermediaries means that before you get, if this was your payment, okay, and you wanted to send, let's say, I don't know, £50, okay, to, and I'm going to start from the UK, and you want to send £50 to your, I don't know, a loved one. I'll just use, for example, one of the countries I'm from, so Dominica. So I wanted to send £50 to Dominica, All right. And when it gets there, it needs to get there in their currency denomination. It can't get there in pounds because they can't use it. So in Dominica, we use Eastern Caribbean dollars or East Caribbean dollars. All right. And so through these intermediaries, what would this look like? I was going to save this intro for next week, but I think it's good to put the picture as to how powerful what we're about to come into is. All right. So £50 to UK, and you wanted to get there in Caribbean dollars. So if we do this, the cumulative intermediaries we have are going to be quite a few. Okay. So first of all, you're going to have your own, let's put this here, the High Street Bank. So High Street Bank is going to initiate the transaction. But when it leaves there, it doesn't just go directly to their bank as you may think. Okay. The next place we're going to have to go to is that we're going to need another holding bank. Okay. So let's say, for example, holding banking institute, or just put holding banking party. Shoot. Sorry. Writing's getting small. I think I've been staring at the chart all day. So we have this, an institute there. Let's put this down here. All right. I'll fix the spelling in a moment, but we have this cumulative intermediary. So we have a holding bank institute, okay? And then we have the next thing. We need somewhere where, for example, the money goes over to there, and that maybe might take, let's say, okay, 2 or 3 hours, okay? Or let's just make it 2 hours, okay? And then the money will be held either in the same currency or into another one. And each time that happens, where the fees come from is from exchange, okay? So they use the Forex market, okay, to make an exchange because they need to the exchange the currency into the denomination you want, okay? So there needs to be an exchange. And then after, from there, maybe you have a local one. Then you have maybe an international one, let's say, bank number 2, which will be probably like a liquidity provider for, I don't know, the Caribbean, e.g. East Caribbean, a large Eastern Caribbean. Okay, liquidity provider, I'm going to call it LQ for short, LQP, liquidity provider. And that may take another 2 hours or even the next day. Now, of course, if you pay certain fees, you can get it there quicker or later, okay, and how quick they process it, okay? So, and then we have maybe they translate into another currency. Now, I'm not going through which currency is which. I'm not trying to like delve too deep into it, but this is what happens. So your money that goes to the bank, they will take their fee for processing the transaction, okay? And then the holding institute will also take theirs, okay? And then the liquidity provider, okay, where the money is sent from one place to another. So another major connection between, two major banking institutes. I'll change this writing. And then after we have another exchange possibly, okay, in a hypothetical example. And then it reaches the said person, okay, that who wants the money, or who wants the money, or who needs the money, who has it been sent to them, okay? And so in this process of whatever happens, we have things like, for example, in these intermediaries, they put what we call premiums, okay, or spreads, okay, premium, similar to what we have on the charts, where you have the broker the broker is another form of a middleman, where they give you access to trade the market, but they add their own premium on top. So every time you buy and sell, they add their own extra price point on top to make money from, okay? So premium, okay, so spreads, for example, spreads on spot prices and things like that. Now, if you're translating money into a currency, especially one that's not a common exchange, okay, then that means that we're gonna have a higher premium because it's not as liquid. All right. So I'm gonna put this here, um, more, I put the more illiquid. Okay, so it means the more money flowing in that specific exchange, the more illiquid. Okay, the more premium you have to pay. Okay, so you notice that sending money, from pounds to US dollar by a normal means of international exchange might be cheaper, let's say, than doing it for, let's say, I don't know, not to offend any country, but a country that's not, maybe I say, for example, the Marshall Islands, if they have a currency, if they don't have their own currency, or Polynesia, okay, like a very not very known about country, very tiny country, the premiums will be more because there's going to be more intermediates that need to go through to make sure that your transaction gets complete and the person on the other end gets that denomination. Okay, and this is what we have, and all of these cumulative intermediaries is what racks up the bill. So for example, if you the bill or the fees that you have to pay. So you send in £50, you're not going to get exactly just sending £50. It may be £50 plus £12.50 or £15. Okay, so in actual fact, you have to pay more for the same £50 you'd like to send to somebody. And this is what centralization is caused. By centralization, it's created industries of a monopoly of many, many people, that can take advantage, and charge crazy fees sometimes for simple transactions that should be a normal right to everybody. Okay. And as you've probably guessed by now, what does decentralization do? So the industry that we're moving into in these next 10 years, especially, we're going to see the most rapid growth is what is called decentralized finance. Okay. Decentralized finance, okay, or DeFi for short. Now, I just usually call it DeFi, but decentralized finance. Now, when we talk about the finance industry or banking systems and things like that, okay, what are the aspects of these industries? So if I just put finance or just financial banking, finance and banking would be the better term, okay? Now, forgive the typos, guys. All right. I'm When I'm doing these sessions, I'm just talking from my heart. Nothing is pre-planned. I'm sharing with you, from my heart. So with a financial system, okay, what are the things that are available? That there's lending, okay, all right. So there's borrowing, okay, okay. So lending for earning, okay. There's borrowing. So I'm gonna put this loans, the ability to take out loans, okay. The ability to earn interest, okay. Okay. And then also we're gonna put I wouldn't say as necessarily, I would say a store of currency. So if you're making notes, you can write these things down. A store of currency. All right. And other things that we'll describe in a moment. All right. So now decentralized finance, what is it? Okay. Decentralized finance, as the name suggests, okay, is financial. I'm gonna put this here, financial banking, all right, without centralized parties involved, okay, to monopolize or able to monopolize, okay. And I'll put some more space here if I can get the space. Able to monopolize. Now, with decentralized finance, it's based on tech and a new form of technology that has been, talked about since the time of Bitcoin and Ethereum and different things like that. Okay, but decentralized finance allows for everything we'll get with our normal finance and banking in the centralized system, but now in decentralized finance, to put into simple terms, all right, financial banking can be done without the need of this very important term that you're going to hear me say more and more, permission. Okay, in other words, it is permissionless. Okay, So the term for those of you who may look into crypto, you've never looked into crypto, you've heard me say probably once or twice, is this term which is permissionless. All right. Another thing that it is trustless, and this doesn't mean that you can't trust the system. In fact, you can actually trust the system. All right. So we have what we call trustless system. All right. All right. So in other words, we have mutual, and this is important, mutual, immutable agreements. Okay. And these agreements are based on cryptography or cryptographic technology. Okay. Cryptology. I'll just put crypto tech for short, just to keep it nice and colloquial. All right. So we have this trustless system. Okay. So with decentralized finance, okay, the rules are changing very rapidly, where the power has been brought back to the people. Now, it's not a revolution for a revolt, but revolution for us to get back to what a system of economy should be, where everybody has the right, okay, to be having access to, first of all, a system of finance to be able to interact with the world around them. Now, as I said earlier on, I said I would come back to this. A third of the banking infrastructure, or the third of the world, does not have a banking infrastructure. Now, I don't know why it says has; it should say has not, or does not. For the, and I mean personally, not that the country doesn't, but they themselves don't. Okay, there are some countries where there is a vast majority of people who have banks, and then there are some people who still don't. For example, people who live in indigenous areas or villages and etc. Okay, who are not, maybe don't follow the same rules of how life is in the city. Okay, but it doesn't mean that they should be restricted to banking. And with centralization, okay, what are the things that are limits? Okay, so in terms of borrowing in a centralized system, okay, you need to have a credit score. Okay, and in order for you to have a credit score, okay, they need to know deep details about you that is private things. And the thing about these deep details, okay, to have no real privacy, is that something that can happen is that they have your data. So data is centralized and stored, okay, for manipulation. And that's just the truth, okay? Data is stored for manipulation of the people. All right. Now, there is the Data Protection Act that they say and everything like that. But in reality, if you stay with people for a very long time, your data doesn't go anywhere. It just gets stored on a cloud somewhere, excuse me, to be used again, for another time. For all of us, I'm sure you've all experienced cold calls at one time or another. I'm sure you have, where people call you and they ask you if you want to buy a new, I don't know. Sometimes some of the stuff they ask are just strange, but if you need a loan and you ask them how to get my number, then you hear the dial tone. Okay, all of these different things. All right, there's a lot of money to be made in data, and one of the biggest things that is coming even into the 2030s and will become more apparent is this thing that I'm going to write here. Now, this is not a teaching for now, but it's a teaching for the future, which is data harvesting. Okay, data harvesting. Information is power. Okay, and with centralization, it relies on the fact that you need to trust the system. Okay, so I'm gonna write this here. The issue is that right now you have to trust the system. And not only that, all right, I'm going to put this in line so that you can remember it that way. When you have to trust this system, you're already why this system is already a failed system, okay? And I'm so glad that it's soon breaking down, is because the front end is not the only party involved in your transactions, okay? And one time I'll bring up the diagram for you to see this, all right? Now, whenever you have when you have a party or anything that in terms of a banking system or a party that's involved in finance to do with you, whenever you do a transaction or whatever with them, all right, they have your data, which can be harvested, can be stored, can be kept. Governments can have access to that information at any time, and they've made sure they put themselves in positions where they can grab on that information, with a few uh, red lines in a piece of paper, all right? So, or in an email. Now, the front end is not the only party involved. Every transaction you do, okay, now it doesn't mean a conspiracy theory like you're trying to hide, but the level of exposure or the level of privacy, that every human has should be a human right. Okay. And we can see it from history, for those of you who know, how many hacks have happened. PlayStation Network got hacked. This institution got hacked. This person was targeted with a DDoS attack. Okay. And all these different hacking things that happen. And what happens whenever these hacks happen? Yes, the company gets defamed and they will quietly get bailed out and they continue in operation. But the people who have their information there are the ones that suffer, because nobody ever asks the question. And I'm sure maybe you have or you haven't, but all of that data they've stolen, these thieves have not been caught. These cyber thieves have not been caught. And they still have 300 million, for example, email addresses and the phone numbers, bank details, you know. And even though they say, we're sorry, the details have happened, we've changed your password, but these people still have very, very important information for you, in front of you, sorry. And the biggest thing, which is going to be very apparent, as I said, in the next 9 years onwards, is these people who have all of this data, when they come out of the shadows and, try to create their own manipulation, okay, some of the things that, people thought they were safe in, or some of the areas where they thought they were more safe in, they'll find out that they're not. Okay. And it all comes from this centralized system where, they want to know every single thing about you. So this isn't a thing of rebellion where, yeah, you want to try to use it to do crime or something like that, or to be hidden. This is not the case. And I want to say that for the video. It's not for that, but rather for you to have control over how much information you release. Now, this technology, of course, is built on blockchain technology, okay, which is a lot faster and a lot more efficient. Now, not only blockchain technology, but what we call distributed ledger technology. So crypto technology, okay, on the other hand, is based on distributed ledger technology, okay? Distributed ledger technology, okay? Or DLTs as we call them. Now, DLTs take on different forms. So I know that for now, we always talk about cryptos and the first thing you think of is blockchain, but blockchain isn't the only type of cryptographic technology that's out there. Okay, so with DLTs, you can have, and I put this here, for example, you can have a blockchain, okay? And this type of terminology, blockchain, just describes the topology of the system. Okay, so in this topology, okay, I'm going to put this here, each block, okay, of information is stacked on the next, like blocks, okay? So in this technology, each new block that's formed, which will be a snapshot of time that has a certain amount of data within it, okay, is stacked onto the next one, like Lego blocks. Then we have the next one, which is, for example, hash graphs, okay? Hash graphs, okay, are based on certain algorithms, okay, which we call consensus algorithms. Now, I'm giving you previews into the next lessons, but consensus algorithms are, just as they say, they're to bring consensus or to bring an agreement on a network or on a thing. Okay, so blockchain, hash graph, stuff like that. Okay, I'm not going to go into too much detail about hash graph because it's a bit more complex, but we have these kind of structures here. For example, these are two examples. All right. And so with this system, why this system is beautiful, okay, when it comes to finance, is because why? Number one, we have a trustless system. In other words, when two parties need to do a transaction, number one, we no more need intermediaries. So I'm going to say this already in advance. You're going to notice that many companies who act as intermediaries now for payment systems are going to really, really start going out of business unless they change into crypto and change their business model. Okay, because this system is rapidly getting rid of the fact that you need a middleman. And the reason is, without going into too much details, because of the technology it's based on. Okay, so Okay. Any person from any place can do business with another person without a central authority having to audit, be involved, control anything to do with that transaction. Okay. Now, what happens here with DeFi, okay, and why it's so powerful is that currently in the world we have a two-third ratio, okay, of banking, or people who are banked will have a bank account. Now with DeFi, okay, the whole world now can actually have access. So we have, if whatever the market cap of the world is, I believe the market cap of the world is something trillion, many trillions of dollars. I think 22 trillion or even more. All right, and that's based on two-thirds. Okay, the one third that's not there, if we were to do a quick calculation, means that another at least another $11 trillion, and if not more, amounts of money are going to come into this market. And so we're going to have a new looking, good looking financial system and financial, ways and means to do business and to have, finance and banking. Okay. And so this is opening up one third of the world, or probably even more, okay, to banking, because with the centralized situation, you have to trust the system. Your transactions have to be involved in party, have to be, run through many, many different parties before it gets to the other end. Even though it happens very quickly, I guess because it happens quickly, it seems like, although it's just like an in and out thing, but it's kind of like an in, then over here, then over here, then over here, then out. Okay. But it just happens really quickly. All right. So one of the barriers to entry, for example, that we have, for example, getting access to capital is credit score. Many people don't have a great credit score. Many people who don't have a great credit score, excuse me, I should say, don't have access to the ability to borrow, money from an institution like a high street bank, let's say, because their credit score is too low. And it's based on how well they are good at walking, or how good they are at paying back their debts. That's all it really means. Okay, which, I mean, to some seems as a very good measure, or a good assessment of how well somebody's financial, abilities are. Okay, which is not exactly the case. All right, with decentralized finance, we have something which is very exciting. Okay, in two parts. All right, so in terms of the barriers of entry to be able to get access to capital is being lowered completely. And now what we have is this thing here. Oh, we have, first of all, right now, we have over collateralized loans. Okay. And we also have under collateralized loans. Excuse me. Throat is dry today. I think I've been talking all day. Under over collateralized loans. So let me change this. All right. And then we have over. So to make it short, what they are. So over collateralized loans means that you need to, in order for you to take out a loan, or for you to have access to a different type of a cryptocurrency, for example, you need to have more, more than you're loaning out. So if you want, let's say, Ethereum, 10 Ethereums, and the exchange rate is 10 Ethereums for, I don't know, 4 Bitcoin, which is will be more than 10 Ethereums, for example, then that's what you need to put into the system to get it. I'm just giving a very wild example. Okay. Okay. And under collateralized loans. So under collateralized loans at the moment is where, I guess, the finance and banking industry kind of have their hands still, you know, there. Sorry about the spelling. All right. This whole term of collateralized comes from collateral, which means, something that you put down, some sort of value to represent, you know, a collateral. Okay. In the case of something happening that can be liquidated, to be used. So over collateralized loans is what we have. And also there's work right now for under collateralized loans. Now, spelling keeps going all over the place, but let's put this here, under. All right. So with these two things that we have here within DeFi, okay, not only do you have the ability, the barrier to entry to get into loans is just to have assets, which is what the system should be about. Okay. So in this centralized system, the credit score situation does not exist. All right. Now, what we have is cryptology. Now, cryptology, because we have this technology which is immutable, which means that it cannot be changed. Okay. We have what we call smart contracts. Okay. So, smart contracts, see them as, all right, they're not actually contracts, they're just automated programs that repeat certain, that continuously do certain activities if certain events happen. For example, if somebody wants to, do a transaction with somebody else, it goes through that system of the smart contract. Okay. And both parties, if they both meet the agreement, then a decision is made. If one side doesn't meet the agreement because he's trying to be fraudulent or vice versa, then the agreement doesn't go through. Okay. And this cannot be changed. So in other words, we don't have to look for a credit score, and we don't have to trust the system. We don't have to trust anybody else in the system. But what we can do is that we can come to a mutual agreement. Okay. And this is a lot better as an economy. All right. And we have different companies that, for example, if you want to go and check out Compound, different cryptocurrency projects, all right, in the DeFi, arena, which are very powerful. So throwing these terms out here, when it comes to lending now, I'm going to end off here. I know these ones are longer. If you can't stay, I understand. I'm trying to make these slightly longer so we can get the point across. All right. Let's talk about lending. Okay. Before I talk about lending, I'm going to go and dip my toes into fractional reserve banking. Okay. So with fractional reserve banking, what does that look like? So the whole picture of fractional reserve banking really resounds what the centralized system, does to not help people, but rather to help themselves. Okay. So I'm going to delete some of these things that I have here because I have so many things written down. All right. I'm hoping soon that we can switch over and have the whiteboard app and I can just write with a pen instead. But I guess sometimes I have scientific, chicken scratch handwriting. So I get worried that you might not be able to read it, but we'll do that. We'll try it out. Okay. So we'll get rid of this stuff and let's have some fresh space. All right. So fractional reserve banking, to make it very short and simple, if you want to describe it to yourself or find out from, you know, find out the basics and you wanted some guidelines as to where to go, this will be it. So first thing, the concept is now, we need to remember that level one, central banks make monetary policy. And one of the policies they can create is basically this thing here, which is how much banks can legally hold compared to the balances of customer accounts. Okay. This is one major aspect of it, okay, which is the idea that I want to bring to the table for you to think about as to why this system is here and why it needs to go. All right. So fractional reserve banking is how much banks can legally hold compared to the balances of a customer. Now, what does this look like? So let's say, all right, here's you, customer, okay, and you have £1,000 that let's make it a bit more, you know, let's make the value a bit larger. So you're a customer, there's 100,000 here, and then you, as a customer, you go over to your local bank, okay? So let's say local high street bank. So you want to place this money, okay? Either you transfer it in or you deposit in the cash, whichever way you do it, into your um, local bank high street. All right. Now, when this money comes into the system, as I said, one of the things about this system, which most people still don't know, is that whenever you're doing business right now with a centralized institution, it looks like you're doing business with just one party when in fact you're doing business with parties that you can't see. Okay. And banks know that you would never bother to go to look into. Okay. And even if you did look into it, the government has their back. So central banks have their back and the central banks and the governments are working together. So what can you actually do? All right. So in this system we have here, local high street bank. So the money comes in and it gets taken. So now your account is credited at, say, All right, 100,000. Now, when this money is put in, you as a customer, because of how you've been conditioned and how we've all been conditioned, or at one time were conditioned, hopefully, and you've changed your mind now. All right, customer credit or customer's account balance is now 100,000. Let's say you just didn't have anything in there and you put this amount in. All right. So this is how much he has. Now there is a law, okay, and I'm going to open up the Bank of England things for you to see in a moment, and the regulatory money regulations on that or policy. When you put that money in there, for us, as I believed, that 100,000 is actually there, when in fact it's not. Okay. What banks do, because people always wonder, how do banks make money if they just take your money? And now, of course, we know loans, but we don't know loans the same way that they know loans. All right. And I'm going to show you this today and end the session. All right. To get you thinking. So your balance isn't actually 100,000 in the sense that that's what's actually in your account. All right. Now, in terms of the nominal value, it's 100,000. And if you put in a savings account, you could even see it, gain and interest. But really and truly, it is just numbers on a screen. Okay. Why? With this law, or call it a law, but an act, okay, Fractional Reserve Banking Act, okay, and the policies that come with it, all right, banks, okay, and large banks too, can hold a fraction, or what we call a fractional reserve, of that balance in your account and use the rest, okay, that's been put into the system that you can't see, for other things, for investing, for loaning it out to other people. Now, right now, I believe that in the UK, I'm speaking for the UK because I'm not too sure about other countries, okay, but the actual percentage that central banks allow. Now, this other 90%, okay, that is not seen. So it's 10%, sorry. Okay, so UK law is 10%. Banks only have to hold 10% of that balance. So 10% would be 10K. So if you put right now, I'll put this 10% reserve. So if you go to the bank right now and you put £100,000 in, okay, 10% would be left over of what is really in there in terms of the real balance. Okay, the other 90,000 gets, magically shifted over to many different things. Now, how do banks make their money? So, for example, all right, let's say that this is even a savings account. So this is a 1% savings account that you've put it into. Savings account. And they give you 1% back, all right, every time you save. You know what, let's even make it a bit nicer. Let's do it 2%, okay? So we'll do 2%. And I'm not talking about inflation or anything right now. I talked about that last week. I'll touch on in a moment. So this 10,000 in here, this is what you really have. All right. The 90,000, what happens? So let's say, all right. So I'm going to put this here. The 90,000 is used for lending, okay, to other customers and businesses also, okay? Now, you can't see this, and this is why this monopoly is so powerful. Because the system hasn't broken down just yet in the recent years, I think most people have forgotten that when it breaks down, you really realize that there's not actually not as much money in the system as the banks want us to, and the governments want us to believe, okay? And so they lend to other customers and other businesses, all right? So what they will do, all right? Let's say, for example, I'm going to use this example. Somebody wants to get a house, so a mortgage, okay? And the mortgage costs about 500,000, right? 500,000 roughly. So I'll put this here, 500,000, all right? Now let's say that they're going to loan them this out at 4%, okay? Let's even make it better. Let's just go for what is roughly around about 6%, okay? APY. So they have to pay 6% on top of this mortgage loan, okay? And that works out to be, can someone calculate that for me? What is 6% of 500,000? Anybody got it? 6% of, all right, 30K. All right. So the bank is making 30K interest. All right. Let me put this here. So let's just put in pounds. So 30,000, okay, for the 6% per year. That's what they make. Okay. And this is, set in stone. This is the contract that they have. Okay. And so when I was talking about how banks can, for example, I said it last week. I was there. I worked in a building society, but it's the same thing. Okay. For every 1% they give you, all right, they give, they make, a substantial amount, okay, back. So if I put this here, all right, and we write this down. So what is 2% now? Somebody tell me, what is 2% of 10K, of 100K? What is that equal to? Can anybody tell me? I just want to get you guys a bit active. So somebody tell me, what is 2% of 100K? 2K, thanks. 2,000, okay. 2,000, all right. So we have £2,000 here. Okay. So with this £2,000, okay, that we have, okay, okay, what's happening here? So the government, if well, I wouldn't even talk about the government, but let's just say, so how much the banks are really earning is not this 6% that they say per annum. It seems like that, but it's a lot more. And if you do some interest rates adjustment, okay, they're actually earning even more. But we're just talking about from a nominal standpoint. So on the 100,000, okay, on, let's put this here. So the reserves that they have, okay, that they're using is, let's put this here. All right. If you want to calculate this, so reserves, now I'm going to put this here so that it can make sense. Reserves profit, or what they really make, real profit. Sorry. So when we talk about percentages, how much they're really working, because they've got this, they have their 10% in reserves, because the 90,000, if you want to know where it comes from, out of this, or gives the right for them, is that the central bank provides them credit, okay, or digits on the screen, money that doesn't actually, I mean, it can be credited, but it's just credit, it doesn't exist. Okay, the real money is the 10,000. So what you have here is that on the money that they've taken, so the 90,000 that they've taken, they're making 30K off of that. Okay, so on the reserves, if you want to calculate it, what that would be 30, in this case 30K divided by 10K. Okay, and this is going to equal to the real profit they're actually making. So real profit. So in essence, how much they're actually making in percentage, they're making 300% profit. Okay, instead of 6% as it seems. Okay, so when they, these institutions are giving these low rates, they're not giving them, it looks very nice and it looks like they're very kind people, but they're really not. Okay, and you can imagine that 6% is, I mean, it's not so high, but there are even higher ones. So you can only imagine how we can get to a number like 2,200% using leverage. Now, you've always heard me say that term over and over again. Okay, but now you know why, what the leverage is. The leverage that these guys have, high street banks and larger banks to do these kind of things is from the central banks, from the policy. The rules have been rigged in their favor in this centralized institution to the disfavor of people. Now, for those of you who've probably heard me say this, okay, for example, mortgages. Now, I'm not giving financial advice and this doesn't equate to it, okay, but for example, mortgage. The term mortgage, let me just put this here, all right, represents what? Death grip. That's what it means in Latin. It's funny how, many of the words that are but not good for the people who are in Latin, not because of Latin or anything, but it's just that it's good for us to have these understandings in this from Latin speeches, so we can keep a record. We have fiat and we have mortgage, okay, and it's good for us to remember. So was they all in Latin? You can remember. Helps me to remember too. All right. So mortgage means debt grip, even in French. Okay. Me being a semi-French speaker, it means death grip also. Okay. And so with these situations here, just imagine this is per year, and usually some people die and don't even pay off their mortgage. Okay. And this is a continuing debt, and banks have a grip of you, okay, until you die. Hence why this term was created. So sometimes mortgages may take 60 years to pay off, 50 years to pay off, 40 years to pay off. And hence why this is why we do what we do in understanding cryptos and forex and trading, because in order for you to beat this system, first thing you have to recognize is that time, okay, cannot equal to money. Because if you do time equals to money, you're always going to come out on the short end. Instead, what you need to be thinking is knowledge equals to money. Okay. Now, one of my favorite, I'll say, mentors that is, he's mentored me without knowing me, is Robert Kiyosaki. I love the way he's angle on this. But we have the time equals to money. Okay. And time equaling to money is what we call the employment level. Okay. Time equaling to money. So you do a certain amount of hours. So for example, 9 to 5, okay, or what we call the rat race. All right. And then you do that, and then whatever time you put in equals the amount of money that you get to. All right. Then we have the next level, which is, okay, you're a sole trader, for example. Sole trader. All right. You use your skill, okay, for and then you use your skill, and that skill will give you a certain amount of money. Okay, so the multiplication effect is a bit better. So I put this here, skill or slash trade equals to money. For example, a hairdresser, a barber, a private tutor, you know, those in the economy compared to people in 9 to 5 are way better off already. Multitudes already are way better off because they've already got the understanding that they're using this skill, and because skill you can adjust your skill or what you do as a skill. Let me put this here, for example, equals to money. The major crux in between there is that you have, all right, value, and I want you to keep this with you. All right. So, when I always do my meditations, I always think of this value, okay, determination. All right. So, in this first aspect here, to expound on what Robert Kiyosaki said, if we discuss this, when you're in employment, okay, and I'll end off here, when you're in employment, you have to decide, or the people that are ahead of you, or the people that hire you, decide what your value is. When you move down to the next level of skill or trade, or trades, I should say, instead of trader, because that's not what it is, skill or tradesman or tradeswoman, okay, you get to determine to a certain amount what your value is, what your worth is, in the sense that you're still having to use physical strength. Okay, if you, for example, if you're a hairdresser, you may or do makeup for people or things of that nature. If you're doing makeup, maybe you're physically active 10 hours a day, so you're still using your strength. However, based on your skill and how well you refine your skill and how in demand you are, so you get to create your own supply and demand cycle, or determine how valuable, how much money you get in return. So you still get a better rate of return because at least you have some sort of control. But it's not the best. Why? Because the biggest issue here is that you still have to physically be there for 10 hours a day. Then we get into the next level, which is business. Okay. And business now is uh you you're leveraging, I'll put this here, people's skills. I'll say people's skills, intelligence, and manpower too. Okay, to equal to money. So now you've got people you're leveraging people and the strength of people, whether it's mental strength, skills, physical skills, intelligence, to make money. Okay, so now this is the next level. All right. Then the final level, which is where we want to get to, okay, and is the most powerful level, is an investor. Because an investor, okay, all right, what money was meant to be was Money is your employee. Okay. So as I always say, figurative speaking, your money wakes up in the morning and goes to sleep after it does its job. Now, for you to be an investor, what would be the equation here? All right. Value by knowledge. So in terms of, the more the more harder you work, the more money you make. That's a very, very low exchange rate. Okay. It's more like the system that these guys want you to be trapped in, because it fuels their system. If we start to realize this, in greater amounts as it's happening, this system immediately gets to break down for several reasons. Okay. So an investor, value by knowledge, the more you know equals to the more money you can make. Why do I say this? Let's say you have a £200 account and you're trading. If you know exactly where the algorithm of the market is moving money, you can place very, very pinpoint accurate trades and be able to maximize on those trades and be able to turn a £200 account into a £1,000 account, let's say in a week. Now, if you don't know that, then you may even lose the £200, or you might lose something of it. Okay, so knowledge is involved. All right. And I think the reason why, people don't like to go into these areas, especially investor or business, is because as you go up, the risk is higher. Okay. But without risk, as you've known through trading, there isn't any reward. Being in the employment stage, not that you can't be an employee, don't get it wrong with what I'm saying. I'm saying that being in the employment stage, okay, if you believe you can do greater, what usually holds you back is the fear of taking a risk, a fear of stepping out. And that fear, even though it seems like it's natural, it's not natural. It's been engineered into our education system, into all of the media, to make you stay in this area, because this area fuels this system. Okay, for example, this area to a certain degree relies on employment and stuff like that. This is why employment rates are so important, because if this system, starts to break down and stuff like that, then these guys quickly run in and pour more money into the system to cover up, already a broken system. Okay. So what about decentralized finance? Now this system does not work. In this system there is fairness. Okay. Now there are things where you can earn crazy amounts of interest, which is called yield farming, which is for another lesson. But nonetheless, okay, what happens is that when you get into DeFi, okay, money in savings, not only do you make real interest that doesn't have inflation attached to it the same way we have here, because even with this 2%, all right, as I've told you before, savers, as Robert Kiyosaki rightly says, are losers, because usually savings accounts, okay, inflation is usually higher than savings accounts, rates. And if that's the case, even if your nominal value goes up, your actual buying power goes down. So let's say 3% inflation, okay? S- All right. No worries. No, okay, no problem, Liam. I'll catch up with you. Catch up with you. All right. Yeah. So these things, no worries, bro. So these things are where we are right now. So with these final notes as I leave out here, okay, I want you to think about this. I know I didn't even get to go into deep detail, all right, but this will be available for you guys to watch as soon as it's done and edited. But I want you to start to think about this. How are you going to get yourself from here to here? Now, just because you're in this window doesn't mean you can't be in multiple windows, which is the thing I think, which I call entrepreneurs' vigor, or the zeal of entrepreneurs, which is sometimes they try to push everybody to be a businessman, and it doesn't make sense, because if everybody has a business, then who's going to be the employee? Do you know what I mean? So there are different dynamics to it. Rather, what you want to be thinking is that, okay, I'm here right now, there's nothing wrong with here is a legitimate place to be, but how do I go to the higher levels and leverage this area to get into these areas, especially into the B and the I? Okay, these two especially. All right. If you start from the S, from the skill, that you're even at a better standpoint. Okay, but what you want to think about is the guys in the B, or the E, sorry, and the S/T. You want to be making your way over here, and DeFi is the open door for us to have a completely changed system where you can actually do those kind of things without interference of intermediaries. Now, I've said a lot. I'm going to end this session there. If there are any questions, please send them out to me. If it's on YouTube, put it in the comments. If it's students or anything inside the school, send me a message. I know I've said a lot, and it was a bit shaky. It's been a very, very long day, but I hope you did take something from that. Okay, and we will resume this, in the next series next week. Okay, so I hope you guys enjoyed. All right, and please take care of yourselves, and I'll catch up with you soon. Okay, bye.